Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. Guys, the economic data that was released this morning was an absolute nightmare. It's the worst of all worlds. We're going to explain exactly what's going on and what that data means for you going forward. So let's dive in.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. We have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening.
All right, Bob. So we had core PCE, which is the core measure of inflation for the Fed, or at least the one that they really worry about. And that came in hot. And then on top of that, we had GDP come in, and that came in way off the mark. One of the bigger misses that we've seen showing contraction. So what do you think that spells for us going forward here over the next couple quarters?
Yeah, guys, we've been warning you guys. This is the scenario. It looks like we're breaking to the 70s before we break to 1929. So you got a situation here now where, and we've been talking about this, we did the energy one yesterday, is that they can't take their foot off the brake here of the rates because they'll end up with hyperinflation. But there's a lot of pressure for them to kind of revisit their scenario. I'm going to throw this one thing up. Well, this news article, 2% inflation target regime should be now retired, is that this is the narrative building stage. Okay, the Fed's going to stay out there. We're 2%, we're 2%, we're 2%. And we're seeing now with the data, it's impossible for them to get to 2%. And with the spending on the horizon, and they're going to go ahead and they're going to declare victory and raise it up to 3% or 4%.
Yeah.
And now we're going to be stuck in a higher inflation environment. That's why we love energy, gold, silver, the Bitcoin miners, the Bitcoin proxies are all going to do well in that environment. But as we could see, what doesn't like that environment is FANG dead. Basically the MAG 7. I mean, all 7 of them puked right out of the gate this morning. Some are pulling back higher. And so it's going to be really interesting to see, Phil, are they going to be able to make all-time highs in the stock market without the FANG dead stocks, right? But we could have a situation where even if the indexes don't make new highs, there's going to be plenty of under the cover stocks and sectors that are going to do really, really well. And I think that's what we're going to see here before the whole thing rolls over. And here, I want to show the chart of what this thing looks like. This is freaking scary, okay? This is what you don't want. This morning, this was Biden's worst nightmare, okay? Mm-hmm. This is Jimmy Carter 2.0, where you had a situation, and I call this the inflationary depression model. And the reason why I say that is that prices are increasing on things you have to have, okay? But economic activity crumbles, and the government tries to pick up the mantle by being the spender of last resort, but it doesn't get to the people. It just gets more and more concentrated into the hands of fewer and fewer corporations and fewer people, just by the nature of the beast. It's not necessarily intentional it goes to those people, although they don't care that it does. It's just the nature of the beast, and people at the lower end of the spectrum are on a hamster wheel, and the rich people are sitting there going, I don't know where can I invest all this money I'm getting now with these higher interest rates, and they're bailing out of stocks, and next thing you know it, economic activity falls off the cliff here. And this is the problem with this environment, Phil. You can't fix this easily. You can only fix this structurally, and politicians are loath to take the medicine that needs to be taken here, because that means they have to stop deficit spending.
Yep.
And when they do that, they know, because we already crossed the Rubicon, that's depressionary.
Yep.
And so we're kind of stuck here. And there's only one thing you can do. It is, it's like in an avalanche. You better ski in front of it, or you better get off to the side. I'd like to get your thoughts on this stuff, Phil.
Well, I think it's pretty sad when GDP is contracting and you have as much fiscal spending that you've been having, right? Because fiscal spending, this T-bill issuance, this game that Yellen's been playing actually should be elevating GDP. And the fact that couldn't even get it done this quarter is actually quite shocking to me. So that tells me that the economy is much more worse off than even maybe you and I thought it was. So you got all this stimulus in terms of short-term treasury issuance, and no bueno. It's just not getting it done. So I think, Bob, in this scenario, we'll see what, and who knows what they do for revisions and things like that, right? But I think you have to be cognizant of the fact that what we've been saying is going to happen and turning, basically the big ship turning. And this is like your first, like where the rudder is just now starting to turn and you're starting to get that move to starboard or port, whichever direction, but you're making that turn. The other thing I wanted to also point out is the yield curve on the 210 is starting to creep up even more. So now you've gotten all these elements that we've been telling you to watch for. Really, the only thing that we haven't seen start to accelerate is jobs, unemployment, jobless claims. But if those things start to spike here, Bob, the rate of change on those, then I think we're maybe like a quarter out. Like if I'm looking at the data, I would say I would favor Q4 for a potential recession versus Q3. But if that job data starts to accelerate, then it could be Q3.
Yeah, I mean, I think they can't hide it anymore after next quarter because we already know that they're seasonally adjusting the jobless claims, and we know they're always manipulating unemployment claims. But you brought up a really good point, Phil, is with all this fiscal spending and we're still contracting from a GDP standpoint, it's called pushing on a string. At some point, no matter how much money the government spends, it becomes counterproductive and you have to take your medicine. And we're at that point. So we're crossing all kinds of lines in the sand here. And that's what we say 2025 will be no joke, no bueno. And, I agree with you, Phil. I think they're going to muddle through summer. And that Jackson Hole meeting onward, I think it's going to get really, really wild. And that's when we start rebuilding some of these hedges again in the market. So I tell you guys, this isn't like you're going to be your run-of-the-mill recession, okay? Not at all. I mean, there are things breaking down structurally it's going to be quite scary. And, look, with these jobs that people are losing, they'll never make that kind of money again the rest of their life. This whole thing's going to be stepping down. So you're going to have to be really, really careful, be really, really cautious, and, start working your hedges. And we were talking in the room this morning, Phil, that people with 401k plans, they have very limited opportunities, to shift and focus like we could do when we trade or we have self-directed funds. These choices people are going to have is going to be in the market or out of the market. And I think that's what's really going to cause the markets to really suffer is because people are going to come home saying, I'm down 10%, I can't take it anymore. Take me to cash. And then that's when it's really going to roll over. It's not like people can, shift and glide and, do all that stuff. Those financial advisors, some of them you can't even change them but once a quarter. So, and the only thing you can do is say, take me to cash, and I think that's what we're going to see around election time. Look, if Biden wins, he's going to bring it down because they're going to keep trying to structurally change the country. If Trump wins, they're going to bring it down because they're going to want him to walk into a hornet's nest. And so it's going to be no fun, from the election going forward into 2025. And Phil has a model that says, that 100-week thing has already begun. So that covers all of 2025 into 2026. Phil, any last words? If not, we'll see you guys tomorrow. We're having some good trades here amongst the carnage here, the short-term carnage. But we do think May will probably be a good month, May into the middle of June. So, so there's still going to be some opportunities to make some money here before this whole thing rolls over.
All right, guys, well, let us know what you think in the comments below. Otherwise, we'll see you guys on the next episode. Thanks for tuning in. Thank you, Bob. And we'll see you guys on the next episode. Take care.
Trade Genius.